Imagine this. It's the year 1602. You're standing in a busy square in Amsterdam. Around you, men in long coats are shouting numbers, waving papers, making deals. There's no computer, no phone, no trading app, but something extraordinary is happening right here, right now. These men are doing something the world has never seen before. They are buying and selling small pieces of a company that doesn't even exist yet in its full form. They are taking a risk, and they are changing the history of money forever. Welcome to Michael's Mindcast. I'm Michael, and in the next 15 minutes, we're going to travel back 400 years to discover how one city, one company, and one big idea gave birth to the modern stock market. Let's go. To understand why Amsterdam in 1602 was so important, we need to understand what the world looked like before it. In the 1500s and early 1600s, Europe was obsessed with one thing: trade. Specifically, trade with Asia. Spices, pepper, nutmeg, cinnamon were incredibly valuable. In Europe, these spices were worth more than gold. They could preserve food, make medicine, and make a merchant very, very rich. But getting to Asia was dangerous and expensive. You needed ships, you needed sailors, you needed weapons to protect yourself from pirates. You needed enough food and water for a journey that could take 2 years, and at the end of it all, the ship might never come back. Most of the time, a single wealthy merchant or a small group of merchants would pay for the whole voyage. They put in all the money. They took all the risk. If the ship sank or was attacked or got lost, they lost everything. This system worked, but it had a serious problem. Only very rich people could participate, and even rich people were nervous about losing everything on one voyage. So, how do you solve this problem? You share the risk. In 1602, the Dutch government brought together several competing trading companies and merged them into one giant organization. This organization was called the Verenigde Oost-Indische Compagnie, or, in English, the Dutch East India Company. Most people know it simply as the VOC. The VOC was not just another trading company, it was something completely new. The Dutch government gave the VOC a monopoly on all Dutch trade between Europe and Asia. A monopoly means one company has the exclusive right to do something, no competition allowed. For 21 years, no other Dutch company could trade in the Indian Ocean. This was enormous power. But here is the part that changed everything. The VOC needed money. A lot of money. More than any single merchant or small group of investors could provide. So, the directors of the VOC had an idea. They would open the company's capital, that is, the money and assets needed to run the business, to ordinary people. Capital, in business, simply means the financial resources used to start and run a company. The VOC was looking for capital from the public. Anyone, a rich merchant, a craftsman, even a widow with a small amount of savings, could buy a share in the VOC. In exchange, they would receive a portion of the company's future profits. This was the birth of the joint stock company. A joint stock company is a business where ownership is divided into shares, and many different people can own those shares together. The stock is the total value of those shares. The joint part means you share both the risk and the reward with everyone else. For the first time in history, a large company was owned not by one person or family, but by the public. And the public responded immediately. Within a few weeks in 1602, the VOC raised about 6.4 million guilders. That is an almost unimaginable amount of money for that time. Around 1,800 people invested, from Amsterdam's richest merchants to ordinary workers putting in just a few hundred guilders. But here's where the story gets really interesting. Once people owned shares in the VOC, a new question appeared. What if you need your money back? What if you want to sell? The VOC was not going to give investors their money back early. The company needed those funds to build ships, hire crews, and run operations for years. So the directors said, if you want your money, you have to find someone else to buy your shares. And just like that, a market was born. People began meeting in the streets of Amsterdam, particularly around the Nieuwe Brug, a busy bridge in the city center, to buy and sell VOC shares. Over time, this informal meeting place became the Amsterdam Stock Exchange, known in Dutch as the Beurs. It was the world's first proper stock exchange. A stock exchange is an organized marketplace where buyers and sellers can trade shares in companies. Before Amsterdam, there was no such place. After Amsterdam, the idea spread across the entire world. Now, imagine you are an investor in Amsterdam in 1603. You bought VOC shares a year ago. The first ships haven't even returned from Asia yet. You don't know if the voyage was successful. You don't know if your investment will pay off. But someone in the market is willing to buy your shares today for slightly more than you paid. Should you sell or should you wait? This question, to hold or to sell, is one that investors still ask every single day, 400 years later. The people trading in Amsterdam were asking the same question. And in trying to answer it, they developed something else that sounds very modern: speculation. Speculation means making financial decisions based not on what something is worth today, but on what you think it will be worth in the future. A speculator buys shares not because the company is profitable right now, but because they believe the price will go up. Some of the early VOC traders were pure speculators. They had no real knowledge about ships or spice. They were simply betting on the future. And while speculation can create enormous wealth, it can also create enormous problems, as Amsterdam was about to discover. The Amsterdam market didn't just create a place to trade shares. It also invented many of the financial tools we still use today. Here's one: the option. An option is a contract that gives you the right but not the obligation to buy or sell something at a specific price in the future. Let's say you think VOC shares will rise in value over the next 6 months. You can pay a small fee today for the right to buy shares at today's price in 6 months' time. If the price goes up, you make a profit. If the price goes down, you simply don't use the option, and you only lose the small fee you paid. Traders in Amsterdam were using simple versions of options as early as the first decade of the 1600s. They were also using another tool: the short sell. Short selling is when you sell shares you don't actually own yet, expecting the price to fall. You borrow shares, sell them now at a high price, then buy them back later at a lower price, and return them. The difference is your profit. This sounds complicated, and honestly, even today it confuses a lot of people. But Amsterdam traders were doing this in the early 1600s. They were thinking about markets in ways that were truly ahead of their time. The most famous figure in all of this is a man named Joseph de la Vega. In 1688, nearly a century after the VOC was founded, he wrote a book called Confusión de Confusiones. It was the first book ever written about the stock market, and the amazing thing? Many of the things he described, the emotions of traders, the irrationality of prices, the danger of speculation, are still completely relevant today. De la Vega described the market as a place of greed and fear. He said prices moved not just on real information, but on rumor, on psychology, on crowd behavior. Sound familiar? Now, I want to be honest with you. The story of Amsterdam is not just a success story. There's a darker side too. Because when you give people the ability to speculate, to buy and sell based on hopes and fears about the future, something dangerous can happen. You get a bubble. A financial bubble is when the price of an asset, a share, a house, a tulip, rises far above its real value, driven by excitement and speculation. Everyone is buying because they think the price will keep going up. But eventually, reality catches up. The price collapses, and many people lose enormous amounts of money. Amsterdam saw one of the most famous financial bubbles in history. Ironically, it wasn't about the VOC. It was about tulips. In the 1630s, tulips became wildly popular in the Netherlands. Rare tulip bulbs, particularly ones with unusual color patterns, became a symbol of wealth and status. Demand increased. Prices increased. Speculators started buying tulip contracts, promises to deliver tulips in the future, and the prices kept climbing. At the peak of what became known as tulip mania, a single rare tulip bulb could cost as much as a comfortable house in Amsterdam. Then, in February 1637, the market collapsed almost overnight. Suddenly, nobody wanted to pay those extraordinary prices anymore. Tulip prices fell by over 90% in weeks. Many investors were financially destroyed. The lesson? Speculation without any connection to real value is extremely dangerous. This lesson has been learned and forgotten over and over again throughout history. The dot-com crash of 2000. The housing crisis of 2008. Even some cryptocurrency crashes in recent years. The patterns Amsterdam showed us in the 1600s are still repeating today. So, what exactly did Amsterdam give us? Let's bring it all together. Before 1602, large-scale trade required enormous individual risk. Only the very wealthy could participate in the global economy, and even they were vulnerable to losing everything. The VOC and the Amsterdam Stock Exchange changed that. They created a system where risk could be spread across thousands of people. They gave ordinary citizens the ability to participate in and benefit from the growth of commerce and exploration. And they created the financial instruments, shares, options, dividends, short selling that still form the foundation of global markets today. A dividend, by the way, is the portion of a company's profits that is paid out to its shareholders. It's one of the two main ways investors make money from owning shares. The other is a rise in the share price itself. The VOC paid dividends, sometimes in the form of spices rather than cash, starting in the early 1600s. Today, billions of people around the world receive dividend payments from companies whose shares they own. The VOC itself was extraordinary. At its peak, it was the most valuable company that has ever existed. Adjusted for today's money, its peak valuation is estimated at around $8 trillion. To put that in perspective, Apple, currently one of the most valuable companies in the world, has a market value of around $3 trillion. The VOC was nearly 3 times bigger, and it was built on a simple, powerful idea: share the risk, share the reward. That idea is still alive today every time someone opens a brokerage account, buys a share in a company, or checks the stock market on their phone. Here's what I find most fascinating about the story of Amsterdam. The people who created the first stock market weren't trying to change the world. They were trying to solve a practical problem. How do we fund very expensive, very risky voyages to Asia? And in solving that problem, they created something that would eventually connect billions of people to the global economy. They laid the groundwork for modern capitalism. They invented tools, some brilliant, some dangerous, that we still use 400 years later. The stock market is not a perfect system. As we saw with tulip mania, it can be irrational, emotional, and destructive. But it has also funded extraordinary human progress, from the Industrial Revolution to the technology companies that built the phones we carry in our pockets. Every time you hear a share price on the news, every time a company goes public and ordinary people can buy a piece of it, you are seeing the direct descendant of what happened in Amsterdam in 1602. That is an incredible legacy for a group of merchants standing on a bridge, shouting numbers into the cold Dutch air. If you found this episode useful, share it with someone who loves business history or who wants to understand how money really works. And if you want to keep exploring ideas like this, the history of economics, business strategy, and how the financial world was built, subscribe to Michael's Mindcast. New episodes every week. I'll see you in the next one.